Hello to everybody. Myself, Dr. Rabinarayan Samantra, and I'm going to deliver a simple lecture on the topic income tax provisions in India. This topic has a lot of practical relevance because every individual has to file his income tax return with the income tax authorities. Therefore, it's very important that we understand exactly how the total income or taxable income of an assessee is to be calculated, and also how the tax liability of an assessee is to be calculated in relation to the given previous year by applying the relevant rates of income tax. Before discussing all the technical aspects of the topic, first of all, I'd like to say that as far as the meaning of an assessee is concerned, an assessee is nothing but a taxpayer which is liable to pay taxes, interest, penalty, etc. to the income tax authorities or to the government of India. Now, all incomes earned by the assessee during the relevant previous year will be made chargeable to tax during the next financial year, known as the relevant assessment year. For example, suppose we take 2021 and 22 as the relevant previous year, then naturally all incomes earned by the assessee during this particular year, 2021 and 22, will be subjected to income tax liability or will be assessed to tax during the next year or the financial year 2022 and 23, which is also known as the relevant assessment year. Therefore, briefly stated, an assessment year is nothing but another financial year which comes immediately after the end of the relevant previous year. And now, this is actually the distinction to be made between the two concepts, previous year and an assessment year. Incomes of the previous year are always assessed to tax or generally assessed to tax during the next year, known as the relevant assessment year. Now, as far as the computation of gross total income of an assessee is concerned, such gross total income actually comprises of 5 different heads of incomes, including income from salary, income from house property, income from business or profession, capital gains, and income from other sources. Now, all these different heads of incomes have to be added up, and the sum total would be known as the gross total income of an assessee. As for the meaning of taxable salary income of an assessee is concerned, here you say taxable salary income of an assessee is to be calculated by considering the basic items of salary, including taxable portions of advance or areas of salary received by the assessee during the previous year, then the taxable portion of leave salary, gratuity, pension, etc. received or receivable by the assessee. Next comes the taxable portion of various allowances received by the assessee during the previous year from his employer, such as transport allowance, deputation allowance, house rent allowance, cost of living allowance, DNS allowance, and so on. Here, it is very important to note that only the taxable portions of such allowances are to be taken into consideration as a part of gross salary income of the assessee, and those portions which are actually exempted from tax, those are to be ignored altogether or excluded altogether. Next important component is taxable portions of various perquisites or amenities or facilities which have been provided by the employer to his employee during the relevant previous year, such as housing facility or rent-free accommodation or concessional accommodation, then motor car facility, leave travel concession, then credit card facility, club facility, and so on. Since all such facilities have been provided by the employer to his employee during the relevant previous year, not in cash but in kind, the actual amount of taxable perquisite is to be calculated by applying the relevant provisions of income tax law. Since the time given is extremely limited at the moment, you say, it is not possible to go into all the details of all these aspects, but broadly we should remember that gross salary income of an assessee includes basic items of salary, including pension, gratuity, leave salary, and so on. Then taxable portions of allowances, then taxable portions of various kinds of perquisites granted by the employer to the employee during the relevant previous year. Now, then there is also another important component known as profits in lieu of salary. For example, compensation received by an employee at the time of his voluntary retirement from services. So all these important components have to be taken into consideration, and the sum total would be known as the gross salary income of the assessee. Now, the next important head of income is known as income from house property. In a simple way, we always think that income from house property is exactly what is known as rental income received or receivable from a particular house or building or house property. But under the provisions of the Income Tax Act, the meaning of income from house property is quite broad, you see, and the amount of taxable income arising from house property is to be calculated not only with respect to a let out house or a rented house, but also with respect to a self-occupied house which is occupied by the owner for his own residential purposes. Now next comes income from business or profession. Here you say any amount of income received or receivable by the assessee from any kind of business or profession will be made chargeable to tax under this head of income. Next comes capital gains. Now, although in simple terms we say that capital gain is nothing but the excess of sale price over the actual cost of a particular asset. In fact, this is a highly simplistic meaning of capital gain. When we look into various income tax provisions, in fact, understanding this topic is somewhat very difficult difficult in fact, and therefore all these technical aspects can be taken up for discussion at some later stage. Then finally we have the last head of income known as income from other sources, which includes all those incomes which cannot be classified as belonging to any of the preceding four heads of incomes. Also, all such incomes are known as residual incomes or surplus incomes, and these are to be made chargeable to tax under the last head of income known as income from other sources. Suppose we receive certain amount of interest on bank deposits or deposits made by us with a particular bank. Such amount of interest on bank deposits. Similarly, the fees received by a director for attending various board meetings of the company. Similarly, any amount of rental income received by the assessee from the letting of a vacant piece of land or temporary huts and so on. Now, all these are different examples of incomes from other sources, and these are to be made chargeable to tax under the last head of income. Now, after having computed or calculated the actual amount of income arising under different heads of incomes, the sum total would be known as gross total income of the assessee. Once the gross total income has been calculated, then we are supposed to make permissible deductions available under sections 80C to 80O, so that the balance amount would be known as the taxable income of the assessee. As far as section 80C is concerned, this is actually very important, you see, because an assessee can make certain eligible savings or investments during the relevant previous year, by which he would be able to claim deduction under section 80C maximum up to rupees 1,50,000. This is just an example of one deduction, you see. That there are numerous deductions that may be allowed for. And those things will be taken up for discussion in my subsequent lecture. So for the time being, let us understand that the gross total income is reduced by various deductions available under sections 80C to 80U would be known as the total income or taxable income of the assessee. Now, on the basis of taxable income or total income, we shall be able to calculate the tax liability of the assessee by applying the relevant rates of income tax, or those income tax rates which are actually applicable for the assessment year 2022 and 23. All those rates we shall be discussing after some time, you see. But for the time being, please understand that the amount of tax is always calculated on the basis of an assessee's taxable income or total income by applying the relevant rates of income tax which are applicable for the relevant assessment year, for example 2022 and 23. After the amount of tax has been calculated, then rebate under section 87A can be deducted, provided the assessee's total income or taxable income is not exceeding rupees 5 lakh. And after that, you see some self-assessment tax already paid by the assessee, or the amount of tax deducted at source, or the amount of advance tax paid by the assessee. All these three different amounts are to be deducted from the amount of tax so calculated, you see, so that the balance amount that remains will be known as, or it will be treated as the tax liability of the assessee. These are some of the important points as far as the computation of total income or taxable income or the tax liability of an assessee are concerned. In our next lecture, we shall try to discuss certain other important aspects also. For example, regarding the rates of income tax which are prevailing at present, then a concept known as alternative tax regime, isn't it? And some other important concepts also. Those things will be discussed after some time or in my next lecture. So for the timing, let it be over. My sincere thanks to all of you for having listened to me patiently, you see. Thanks again to all of you.